We're going to talk about market structure. So market structure, very important topic. So market structure is, so what's market structure? Market structure is the way the market behaves. Okay, the market is literally in three basic structures. When you're asked about the human structure, you understand that it's most likely the skeletal frame of a person, the head, the legs, the hands, and that's a human structure, right? Now, when you talk about market structure, how it looks like most of the time. So the market is like in three phases most of the time, either in an uptrend, or it's not going up, it's not going down. It's called the range, or it's in a range, or it's in a downtrend. So when you look at the markets, the candlesticks, the charts, it's either it's pointing upwards, or it's neither pointing up nor down, or it's pointing just downwards. Okay, I'm going to eliminate this one because we don't trade in conditions like this. It's risky. So we focus on either the uptrends and the downtrends. Okay, so it's very, very important. So now, how can we be able to identify an uptrend? So an uptrend is made up of higher highs and higher lows. So what that does it mean when a high is created? Now, this is an example of a high, and this is a low. For instance, when you see the markets going past every single high that was created over and over again, then that's a sign that that's an uptrend. Now we have a new high after it has gone past this one, and there is a low that pushed it to the upside. So you trace it down, this is the low. So it's consistently doing that to go past this high and make it a previous high and form a new one. So this is a new high, and this is a low that sponsored it to this place. And how you trace it is by tracing it with your pointer. From there, you find the low that sponsored it. So this is an ideal uptrend, and a downtrend is an exact opposite from this. Okay, so let's look at how a downtrend is. So a downtrend is most likely going to look like this. First of all, let me start again. So first of all, we have this, we have this, we have this. So we have this as a high, we have this as a low. Okay, now when you find out that the market keeps breaking previous lows every time, keep breaking lows that have been marked and creating new lows consistently over and over again, you know that what's going on. A downtrend is what going on. And if you trace it, you find out the high that sponsored the price to break this previous low. This is the high that sponsored it. If you trace this new one, this is a new low, and when you trace it, there's a high that caused it. Very easy. Now this is a typical example of a downtrend. So now what you need to understand is that these markets do not move in one direction forever. So the market is constantly changing from uptrend to downtrend to range, then up again, then up, then down, just like that. It's just more like a zigzag. So in as much as it's more like a zigzag, don't expect for it to come to USD card 15 minutes time frame, for instance, and you start seeing uptrend. I think it's just gonna be uptrend for life. No, it's always gonna change. They always switch, and that change is called change of character. Okay, so how does the change of character form? If the market is going up like this, you know that, oh, this is an uptrend because it's breaking every high that was formed. It's going past it. So when price stop doing that and decides to start going past every low that was formed, so instead of the price to go higher, it breaks this low. This is the first sign that price is not going to go higher again. It wants to change, and that's called chalk. How is chalk written? Chalk is written like this. Okay, chalk is written like this, so this is a chalk. Okay, and the chalk is change of character in full meaning. So when this happens, in most cases, price wants to do this, breaks down, do this, breaks down, do this, breaks down. Do you see that? So we will just have this curve from here to here, and this is the uptrend side, and then this is a downtrend side. Uptrend, downtrend. Can you see that? So, and also it doesn't stop there. It can change back to uptrend again by breaking highs. The first time price breaks a low, we know it has flipped bearish. The word flip is the word when it turns bearish and it has a change of character. So if it actually breaks this high, we are now bullish back again. So we need this and then a higher high, a higher low, a higher high, a higher low, and then we'll keep going higher. So let's go to the real life charts. We'll look for an uptrend first, we'll look for a downtrend first, second, and then we'll look for how market changes trend often, and that will make sense. So you have been taught how to mark highs and lows on your chart. We'll go to a 4-hour time frame. Okay, so we can easily see cases that we can work with. That we are on live charts right now, so let's look at what we have right here. So when you look at this market, what do you see? All of this place highlighted right here. What do you see? You see a clean uptrend or bullish trend. An uptrend is the same as a bullish trend, same thing. Okay, so as you can see, we have our uptrend. We have this high marked, we have this high marked, we have this high marked, and if we mark this high, where is the low that caused it? This low. So we have this high, where is the low that caused it? If we trace it down, this is a low that caused it. If we mark this high, where is the low that caused it? If we trace it down, this is a low that caused it. If we mark this high, if we trace it down, we find out this is the low that caused it. If we mark this high, where is the low that caused it? If we trace it down, find out that this is the low that caused it. Now take a good look at it again. If we mark this high, see that this is the low that caused it. So you have this right here, okay, as an uptrend, a typical uptrend. So let's go to a downtrend example. You can see what's going on in this box. A downtrend. The market has been moving from up to down. So how do we mark it? This is an uptrend. This is a high. Sorry, where is the low that caused it? This low caused it. By the time we trace it, find out that this low caused it here. That's a high. Now we have a low. It's traceable to the same high. Okay, that's it. So we extend it. We extend it. Now until price breaks this low, we don't have a new low. This is a new low. We have the new low there. You see that? Good. This is a high. You see that? This low and this high. This low is coming from this high. So you mark it. See that? You mark it right there. And then we have this low. And then we have this high. See, this low is leading to this high is leading to this low. And then we have this low, and we know that this high is responsible for it. Okay? So it's easy peasy. You can see it very clear, crystal clear. Okay, so right now, what can we see? So as you can see, highs, lows, highs, lows, highs, lows, highs, lows. See, so now let's go to a time whereby a downtrend switched to an uptrend, so you can see what a change of trend looks like. Okay, so now this is a very swift case of where price changed from what downtrend to uptrend. This is like the junction where it changed. So how are we going to mark it up? So let's see. Let's mark it up. So the downtrend, we start marking from the downtrend as a low. In downtrend, you mark the lows first. Okay, before you trace the highs and let them. This is the high that led to this low. For in uptrend, you mark the highs first before the lows are led to them. So we have this low, and where is the high that led to it? It's visible to this. So no other low till we go here. So we go here. Alright, and this is the high that led to that low. So as you can see, price has to either break this high or break this low if it wants to continue. But then price broke this high. That's how you knew it has changed from being a downtrend now to an uptrend. I'll take my text to it right there and write chalk. Chalk neatly. So you'd see this is a high, this is a high. When you mark a high, the next thing you mark a low. This is an uptrend now, so we mark the highs first. We'll mark the low that led to them. Okay. So we mark this high, and you trace it, you know, it's this low that led to it. And then we'll mark this high, and then you know that this is the low that led to it. And then you mark this high, and then you know that this is the low that led to it. Okay, this high, this is the low that led to it. And then you mark this high that's very visible, and this is the low that led to it. Trace it down, that's the low that actually led to it. Not these lows, not this low, not these lows. This high, this low that started the move till it got to that point. So can you see how it happened? So I'm going to give you one more example of chalk. So let's go again. Okay, in this example, price was going lower, then it switched to bullish, then it came back bearish, then it flipped to bullish back again. So this markup will make you learn a lot how they switch. Change your character doesn't happen just once, it happens as much as possible as long as the trend keeps changing. So this is a downtrend. I can see that it's coming down. So I'm going to mark my lows first, start marking lows, and then trace it to the highs that cause it. So this is the high that caused it. So I'll mark this low. This is the high that caused it. I'll mark this low too, and then this is the high that caused it, and then I'll mark this low and trace it to the high that caused it, and I would mark this low. I'm looking for the obvious ones. I know there are others here, but those are not very obvious. This is very obvious. So this low and this is the high that caused it, and I'll mark this low and this is the high that caused it. So at this point, what you'd find out is I had a new low, and this is the high that caused it too. Understand? So now one thing you should know is this is where the chalk occurred, because price did not break the lows again instead of breaking a high. So we have flipped bullish. Okay, so I write the chalk right there. If you want to reduce the font size, you click on the text 28, use to 16 so I can fit and look more neat. So we have a high now because we are in an uptrend, so we start focusing on highs, and this is a low that caused it. We have a new high, and then this is a low that caused it. Only for price to refuse to go higher again and start breaking lows. So it means we have been able to have a chalk. there too, from down to uptrend and back to downtrend. So we have this window right here. But then price was inside this range for a long time. I mean range, just in between, just in between this high and this low. So it's a range. So it was in between this high and this low. It escaped from it here. That's when we come back to bullish again. So I can call here also a choke because price broke that high and made it flip again, because it was bullish, it flipped bearish, and then it flipped bullish again. So we have that high here, we have that low here, we have that high here. See this high was the low that caused it, and this was a high. And for this high, this is, I would say, this is a low that caused it. This low that was marked a long time ago is responsible for this high, because all along all of these highs do not own this low because it has not broken. But when it broke this low, this high, and this low, no. So we have this low, we have this high, we have this high, high, low, high, low that caused it, this high. Take a look at it. Low, this low pushes price really broke here, then the high was from, that's why it's responsible for this. But now we have this high, and so this low that pushed price to break it. So you see that. So I'll just stop here and you do a task for me after watching this video. Now go read the task in your PDF. So now before we talk about anything, we're going to talk about Fibonacci. So how is Fibonacci used? So as you can see how this market is going up and down, up and down. There's a special rule in trading, and what's the rule? The rule says that if you're in an uptrend, you look for a buy, because some people be like, so what's the benefit of we marking these trends? How does it make us money? So when are we going to buy, when are we going to sell? Now the thing is, there's a general trading rule that says you buy in an uptrend and you sell in a downtrend. So when the market is trading to the upside, you buy. When you trade to the downside, you sell. So what does that really mean? So that really means that when the market is going up like this, you only have to look for buy entries, because the market is going up. When you buy, you're anticipating the market to go higher for you to make money. You have seen reasons, you analyze and you've seen reasons why it's going to go up. And one of the reasons is that if price is in an uptrend, there's a high chance of it going up than it is going down. Get me? So that's why there's that rule that says buying an uptrend, and in the downtrend there's a chance of it going lower and it going higher. That's why it says sell in an uptrend. So where are the right places to buy and the right places to sell? If the market is looking like this, you actually say, where are you going to place your buy order? Now you place your buy order when price has pulled back. Okay, when price has done the pullback, because this is expansion leg and this is retracement leg. The expansion leg is a real move, it's impulsive. The retracement leg is just correctional leg, it does not last long. But the expansion leg is usually longer because it's going up, they are pointing up. So when is the best time for you to buy? Now the best time for you to buy is after the correction leg has been made. But now, do you know, if you start buying here after the correction, as the correction leg is happening, if you start buying here, anything can happen. You might just lose. Why? Because you don't know if price, you don't know, first of all, you don't even know if price will want to change character, and then that would be a loss for you because price will hit your stop loss by trying to do that. So there are other confirmations that will make you know whether it's okay to buy. Sometimes you might say, okay, I'm waiting for price to retrace to here before you buy, then you wait for it here, and then price just retrace a bit and it goes higher. You don't know why, and you miss the trade. So what happens is you want to make use of the Fibonacci tool. Now the Fibonacci tool is used to measure retracement and know when price is ready to continue in the expansion phase. I'll say it again. The Fibonacci is used to calculate how far the retracement can go and when it's time for price to continue the expansion phase. So here is it. So what happens is that when price retraces to its levels, if you draw, how do we draw your FIB? You draw your FIB from the most recent low to the most recent high, because there's always a high and low in the market, but there's always going to be the most recent high and low. That's what you want to focus on. So you want to wait for price to retrace back into the uh, most recent high, most recent low. This is the most recent high, most recent low. You want to wait price to trade back below equilibrium. This is equilibrium price. This is a high and this is a low. This is equilibrium. Equilibrium. So guess what? When price goes below equilibrium, it enters the discount level. So here is called the discount. Below the equilibrium is discount. And here above the equilibrium is what? Premium. So what do you learn here? Now, no matter how you turn this FIB, don't get it twisted. No matter the color of your FIB, the color you choose, how you turn it, the up is always premium and the down is always discount. So what does that mean? Because you're in an uptrend and we want to buy. In reality, when you don't want to buy something, everybody wants to buy at discount prices, right? In reality, when everybody wants to sell, they want to sell expensive so they can make more profit. That's how it works in forex. You want to buy when the market has retraced into discount, and for you to know the discount area, you have to draw your FIB from the most recent low to the most recent high. And around here, the likelihood of the market pumping higher is very high, and that's why you want to buy and place your orders at discount levels. For you to figure out that discount levels, you have to draw your FIB from low to high. As simple as that. So now I'll give you a downtrend example. So in a downtrend, we have to look for sales. But where is the best part to look for sales after a retracement? Okay, so this is our main move or expansion phase. This is correctional or retracement. That's fake. That's not real. This is a real one. That's why it's pointing down. All of this one is the market just trying to breathe and relax after a long day. So this one is another move. So how can you get into sell orders and not get or lose money after a correctional move? Because after a correctional move, this one comes and dumps further, and that's how you make money. So that's why you want to enter. That's why you want to enter around here. So for you to be sure that here is appropriate, you draw your FIB from the most recent high to the most recent low. When I was drawing for an uptrend, I drew it like this from low to high. Now drawing for a downtrend, I'm going to draw it like this. Watch me. Watch me from high to low. Watch me. I'm going to do it from high to low. Do you see that? Exactly. That is because I'm doing it on a downtrend. So here remains my discount, and here remains my premium. The upside is still premium, the downside is still discount. So all I want is for price to be able to retrace to this point. Now, these markets are live markets. They are moving. They are not static. The forex market is progressive. It's always moving. So we will come to the chart and we see it like this. We want to wait for price to crawl into this place, and then we'll now look to put our sell orders, because there's a high chance of price dumping from here lower. See, after a correction, which was around here, after a correction, it dumps. After a correction, it dumps. So now we're in this correction phase, expecting a dump. That's why we're selling there. So if we come and we meet the market already here, we start selling. But if it's not there, we'll wait for price to enter there. Now let's go to the real life chart. Let me show you how it should be used properly. So remember, how do you see Fibonacci? Most recent trend. So let's go to the most recent price action on USD card. The most recent. So what's the most recent price action? The most recent price action is that price was coming down aggressively and then it flipped up. So let's draw our structure. So we'll just start marking from here. Okay, so we had a high, we had a new high, this high, what was the low that caused it? This low. So this high was the low that caused it? This low. So the price, say retracing and the rest of them. So we say having some series of lower highs and lower lows here. Okay. So let's look at it carefully. Okay. So we have low, we have high. We have the lower, it's a downtrend, so I'm marking the lows first, the high that costs them, the low, the high that costs them. Now we are in this range. Okay, we are in this range, and this is a low, and now we broke through this previous high. Can you see that? We broke through this previous high, and guess what? We retraced. Now, as we broke through it, this is chalk. Okay, price was supposed to be going down, but now price is going up. This is chalk. What am I trying to do? I'm trying to find my most recent high and low. I have to mark other things first so I can know what I'm doing. Now we have a high. What's our most recent high and low? This is a most recent high, the most recent low. So we draw your FIB from here up to here. You will see that the market will have to fall inside this place before we start seeing buys to go higher. If it doesn't fall inside this place, then we have no criteria to buy. But we are bullish now, we are flip bullish. So we need the market to do something like this, enter into this discount place, and then start pumping higher. So this is just an example of how to use Fibonacci. Okay. So I'm looking for another example. Okay, let's go to another pair to see another example. Let's go to GBP USD right now. So right now in GBP USD, what are we expecting? What is the market doing? So the market has a clear trend. So this is a low. Okay, so this is a low. This is the high that caused it, very traceable. This is the high that caused it, very traceable. And this is a new low, and this is a high that caused it, very traceable too. And this is a new low, and this is a high that caused it, very traceable too. So now where is the most recent high and low? This and this. So if you draw your FIB from here down to here, that's a win, right? So you see price has retraced into a premium level. This is the upside, is premium, here down, here is discount. So you see from the premium level, as the market entered inside, can you see how the market is now coming down aggressively? Where is the new area the market is coming to? It's coming for this low. Like I said, where is the best places to sell? This is the best places to sell. As the market entered the premium, you put your stop loss in a safe place and you put your take profit down, the market is coming up. So what do you have to understand? There are other things that we have to consider before we buy and sell, but this is like the basic thing you need to know. I'll see you in the next video.